This week, what we've been talking about uh, inventory and managing inventory and the cost of sales. So it kind of goes along with what we were talking about last week. Wahlberg Associates is an antique dealer. They purchased the contents of an estate, which would be like a house or or a mansion or something, but they purchased the contents of the estate for $75,000. Now, the terms of the purchase were FOB shipping point, and the cost of transporting the goods to Wahlberg Associates warehouse was $2,400. So that meant that they, I believe it was FOB shipping point, was that the shipper or the buyer's the one that has to pay for the shipping of it, and it becomes their property at the time that that's done. So Wahlberg Associates insured the shipment at a cost of $300. Prior to putting the goods up for sale, they had to clean and they had to refurbish some of the items at a cost of $980. So we're going to determine the cost of the inventory that's acquired by the estate. So we see here that the contents of the inventory, so maybe it was like couches and kitchen table and chairs and china hutch and those kind of things. The contents were $75,000. They also had to pay the shipping costs of $2,400. They also had to pay insurance of $300. And then they had to clean and refurbish. Maybe some of the things were dusty, they had to clean them. Maybe some of the things, maybe they had to refinish the stain and the clear and all that on them. Maybe some of the things maybe had to get reupholstered. So all of that came up to $980. So the inventory cost then was $78,680. But remember that anything associated with the merchandise is considered part of the inventory cost. We talked about that, I know, in the lecture. By the way, that video's been posted. So anything associated with that is part of the inventory cost. And then, of course, then that's expense. And then part of that, their revenue then would be whatever they sold it for after. Perpetual inventory. So Laker Company reported the January purchases and sales data for its only product. So they only had one product. So on January 1st, they had beginning inventory of 140 units that cost $6 a piece. And then on the 10th of January, they had sales. They sold them at $15 a piece. And then they had January the 20th, they purchased more units. Then they had sales, they purchased more units. So Laker uses what's called a perpetual system. And so that would be based upon the fact that they keep track of their inventory in real time, okay? Similar to like what you'd have like at a retail store, okay? So you're going to determine the costs assigned, to cost of goods sold using specific identification, weighted average, FIFO, and LIFO. And then for specific identification, the ending inventory consists of 200,000 units, where 180 were from January the 30th purchase, 5 were from January the 20th purchase, and 15 were from beginning. So we'll look at these different methods. So we see the first one here would be for the method that is called specific identification. And so for this, we're going to say that the ending inventory consisted of 200,000 units, where 180 were from the January 30th purchase, 5 were from the January the 20th purchase, and 15 were from the beginning. Remember, specific identification, it's where you track that specific unit. And again, usually that's done either through the serial number, or it's done through, like in the case of like a car dealership, it would be done through the VIN number. And you're tracking specifically what it cost you to purchase that particular unit that was available for sale, and then what you sold it for. First of all, we're going to figure out how many units they had, either the units that they sold and the units that they had available to them. We see here that they sold 125 units that were from the beginning inventory at $6. So their cost of goods sold was $7.50. Of the ones that they had from the purchase that they had on January the 20th, they had 5 left. They sold 55 of them, and they purchased them at $5 a piece. So that extends out. So you multiply 55 by 5, that comes out to 275. And then they didn't sell any of them from the January the 30th purchase because they had them all left over. And so then we have then what they sold them, or what they had left. So you have here, this is the total then, and then this is what they had ending. So this is what they sold, and then this is what they still had left in their inventory. So they had beginning inventory of $840 because that's what they had at the beginning. Then they had purchases of $1,110 because they had purchases on January the 20th and January the 30th. So the total of that. Then you had the total cost of goods that were available to sell. So you add up both the beginning and then the purchases was $1,950, and then they had ending inventory, we said, of $925. So we know then that they sold, the cost of goods sold was $1,025. So now we're going to look at weighted average, which this one, what you do then is you take the average then for each of these. It kind of helps smooth out if there's big variations. So we see here that on January the 1st, they started out with 140 units that cost $6, and then that was their ending inventory. So they had 140, they cost them $6, so they had $840 of beginning inventory. And then we see here that on January the 10th, they had 100 units that they sold at $6. So that's $600. That left 40, which they're going to go ahead and then on January the 20th, they purchased more, so 60 at $5. And then they had the 40 from previous, and then they had the 60 that they purchased. And then January 25th, we see that they sold 80 units at $5.40 a unit. Or excuse me, they sold them. But that's what it costs them, because you figure out the average for each of these. And so then we see they had a beginning inventory of $840. They had purchases of $1,110. So they had the cost of goods that were available for sale at $1,950. They had an ending inventory of $918. So the cost of goods sold was $1,023. And then we have a perpetual FIFO, which that would be first in, first out. And so that would be that they're getting rid of the oldest inventory first. So again, we see that on January the 1st, they had 140 units they purchased or they had left over at $6. So they had the beginning inventory of 840. And then on January the 10th, they had sales and they sold 100 of those units that cost them $6 a piece. And so they had 40 of the units left at $6 a piece. So they had $240 ending inventory. And then on January the 20th, they purchased more, 60 units at $5 a piece. So they still had their 40 that they had previous, and then they added 60 to it. They purchased those for $5 a piece, so 300. So that meant that then that on January the 20th, they had 100 units in ending inventory at a balance cost of $540. And then on the 25th, they had sales. They sold 40 of those units for $6 a piece. So they now have sold, since they're going to sell the oldest ones first, they've now sold the units that they had that they purchased at $6.80. So then they sold 40 of them then at the $5 price that they paid. So then they now only have 20 of those original 60 units. They now only have 20 of them left then at $5. And so now their ending inventory is $100. And then on January the 30th, they purchased 180 units at $4.50. So then they now no longer have any at $6. They now have 20 at $5, and they now have 180 at $4.50. So that equals $810. So they now have 200 units available for sale, ending inventory at a cost of $910. And so we see here that they had beginning inventory of $840, purchases of $1,110, total cost of goods that were available for sale of $1,950. They had ending inventory of $910, so they had cost of goods sold of $1,040. And then this is LIFO, which are last in, first out. So that means that they're going to then, rather than selling the oldest first, they're going to sell the newest first. They're going to keep the oldest ones in inventory. So it works. So each one of these, you're going to come out a little bit different in terms of your cost of goods sold. Okay. So then on January the 1st, they had a beginning inventory, as I said, of 140 at $6. And then on the 10th, they had sales. They sold 100 units at $6, so it cost $6. So that meant that they had still had 40 units of them then at $6, because that's all they had available. So ending inventory of 240. And then on the 20th, they purchased more. They purchased 60 at $5. So they still had the 40 at $6, and then they had 60 at $5. So then they had, again, 100 units available. Ending inventory on January the 20th at a balance of 540. And then on the 25th, they had sales. So again, they're going to sell the newest ones first. They're going to keep the oldest ones. So they sold 80 units. So they're going to sell 60 of the units at $5. And then they're going to sell 20 of the original units that they had that they got at $6. So 120. So total of 420 cost. And so they now no longer have any of the units that they purchased for $5. And then they have 20 of the units that they purchased for $6. And then on January the 30th, they had purchases of $180 at $450. So they still have their original 20 of the original units that they had that they paid $6 for. They now no longer have any of the ones that they purchased paid $5 for, and then they have 180 units that they paid $4.50 for. So then they have an ending inventory of 200 units at $930. So they had a beginning inventory of $840, purchases of $1,110, cost of goods available for sale of $1,950. They had an ending inventory of $930. So then that meant then that they had a cost of goods sold of $1,020. Using some of the same information there. So again, using some of the same information there, Laker Company went ahead and reported the following January purchases and sales data for its only product. And so again, we're just going to figure out this time about how that affects their income statement based upon which method of inventory that they use. So we see here that, let me go ahead and bring all this up. Okay, so we see here that the Laker Company had sales of 2,700 they had a cost of goods sold of 1,025. And so they would have had, if we used a specific identification method, they would have had a gross profit of 1,675. And then they had operating expenses of 1,250. So income before tax of 425. They had, if you said that they had 40% income tax, so that's 170. So then their net income, which is our actual net profit, is $255. And so that's with this specific identification method. So then if you were to use weighted average, then we see that they had sales, same sales of 2,700, but this time the cost of goods sold, because we average out the amount that they paid per unit rather than using the amount that they purchased it for, we average out the cost. So we see how they did that here. So the cost of goods sold then would be 1,032. So then they would have had a gross profit of 1,668. So then the operating income then would have been 1,000. Expenses, could be operating expenses would have been 1,250. So the income before tax would have been 418. Income tax at 40% would have been 167. So then they would have had a net income of 251. And if we look at FIFO, then we see then that they would have had same sales, but their cost of goods sold would have been 1,040. Gross profit then would have been 1,660. So the operating expenses would be 1,250. Income before tax of 410. Income tax would have been $164. So the net income would have been 246. And then LIFO then, same sales. This time their cost of goods sold would have been 1,020. So then gross profit would have been 1,680. Operating expenses would have been the same. So the operating expenses would have been for everything else except for their merchandise cost. So it'd be 1,250. So then their income before tax is 430. Their income tax would have been $172. So then their net income would have been $258. So we see that depending upon which inventory method you use, that it's going to vary based upon the amount of profit that you show, and net profit you show will change based upon that. And so let me ask you guys this: what method would yield the highest net income?
LIFO?
LIFO, that is correct. Okay. Now, does net income using weighted average fall below that using FIFO or LIFO? Yeah, it would. So if you look here, you say, so the weighted average, it's going to be in about the middle of each of those, right? Because it's averaging them out the cost over. And then if costs are rising instead of falling, which method would yield the highest net income? So if prices rather than rising, if they're rising rather than falling, which one would be better? Would be FIFO would be better, right? Because FIFO, remember, you use the newest inventory, or you use the oldest inventory. So in FIFO, you use first in, first out. So you use the oldest inventory first. And so, or your oldest, your oldest inventory first, okay? And you leave your newest inventory in. And under LIFO, you use your newest inventory first, and you're going to keep your oldest inventory under LIFO. So first in, first out uses the oldest inventory first, and then your newest inventory. And then LIFO uses the newest inventory first, keeps your oldest inventory. So if that makes sense. So FIFO is kind of similar to how, like at a grocery store, they have to rotate their stock. So they're going to sell the things that are closest date. They're going to want to sell those first, obviously. And then the things that they have more time on, they're going to keep back. Again, not very many companies use LIFO, but there are some that do. And we talked about that in the lecture. Hemming Company reported the following January purchases and sales data for they only had one product. And so again, Hemming uses the perpetual inventory system, determine the cost assigned to cost of goods sold using FIFO and LIFO. And then it says to compute the gross margin for each method. So we see that on this one, that on January the 1st, we had beginning inventory of 200 units. So then they cost us, under FIFO, they cost us $10 a piece. So we had the ending, but that's what we're going to work on first is FIFO. And then on January the 10th, they had sales. So they sold 150 of the units that they started out with. So that cost us, again, so 150 units at $10 cost us $1,500. We're now left with 50 units, so $500 of inventory. On March the 14th, we purchased 350 units that cost us $15 a piece. So they haven't sold them yet, so we just added those to our inventory. So we now have 400 units at a cost of $5,750 because you had $500 worth at 10, and then you had $350, 350 units, excuse me, at 5,250. So that means that you had an initial ending inventory balance of 5,750. So now you sold them. So remember, under FIFO, you're going to sell the oldest inventory first. So you had, or the ones that came in first, you're going to sell first. So you're going to sell your 50 units out, and then you're going to sell 300 of the later units. So now say you're left now with none of the units that you paid $10 for. And then you sold 250 of the units you paid $15 for. So now you're left with 100 of the units you paid $15 for. So you sold 300 units at a total cost of $4,250. And again, your ending inventory, you now have 100 units at a cost of $1,500. And then on July the 30th, you had purchased 450 units, and now they cost $20. So remember, you're going to have, for the ending inventory, you were left with the 100 units previous at $15 a piece, so total of $1,500, and then you have 450 units now that cost $20 that a piece for a total of 9,000. So now you have 550 units at a cost of 10,500. And then on October the 5th, then you had sales of 430 units. So remember then that you're going to sell out 100 of the units that cost $15. So now you're not going to have those. And then the remainder, you'll sell 330 of the units that you paid 20 for. So that leaves you with 120 of those units. So then you had cost of goods sold then of 8,100, and then you are left then with 120 units at a cost of $2,400. And then on October the 26th, you had a purchase of 100 units at 25. And so remember that you're not going to have any of the units that you paid 10 or 15 for, because you've sold those, but you had 120 units that you paid 20 for. So that came up to a total of 2,400, and you have now the units you just bought, 100 units at 25, so that comes out to 2,500. So your total for the cost of goods sold was 13,850, and the total for the ending inventory that you still have is 4,900. So then we can go ahead and do the same thing then for LIFO. So remember that the difference with LIFO then is that with FIFO, you sold the oldest units first. With LIFO, you will sell the newest units, which are the units then that would be at the higher cost. You're going to sell those first, and you will keep the oldest units that were cheaper. You'll keep those on reserve, okay? So we'll look at this. So on January the 1st, we had 200 units at $10, so that's our ending inventory. And then on January the 10th, we sold 150 of those units that cost us $10 a piece, because those are the only units that we have, 1,500. So that left us 50 of the $10 units for an ending inventory balance of 500. Then on March the 14th, we had a purchase of 350 units at $15 a piece. So our ending inventory consists of the 50 units that we had that cost us $10, and then 350 units at $15, which is a 5,250. So then we have 400 units in our ending inventory that cost us 5,750. And then on March the 15th, we had sales of 300 units. So we're going to fill that with 300 units that cost us $15 at 4,500. So that's going to leave us with 50 of the units that cost $15, and that's going to leave us with 50, which are from before, of the units that cost $10. So then that leaves us then with 100 units that have a total cost of 1,250. And then on July the 30th, we're going to purchase 450 units at $20. And so we still have 50 units that cost us 10, 50 units that cost us 15, and then we have the 450 units that we just purchased at 20. So then that would leave us 550 units at a total cost of 10,250. And then on October the 5th, we had sales of 430 units. So we are going to fill that out of the most recent units that we purchased. So 430 units at $20 a piece is $8,600. So that leaves us 20 of the $20 units at $400. That leaves us 50 of the 15 units at $750 and 50 of the $10 units at $500. So we still have 120 units in our inventory at a total cost of $1,650. And then on October the 26th, we purchased 100 units at $25. So then we'll go ahead and add that to our inventory. And so we sold a total of 880 units at a total cost of $14,600. And then we have an ending inventory of 220 units at a cost of $4,150. And so then comparing each of the methods, we still had the same sales, 35,200, but under FIFO, we had cost of goods sold of 13,850. Under LIFO, because again, we're going to sell, so FIFO, we're going to sell the units that we purchased first. So those would have been in our example at a lower cost. Under LIFO, we're going to sell the units that came in more recently. And since costs are increasing, then what we sold was at a higher cost. So at 14,600. So under FIFO, our gross margin is 21,350, and then under LIFO was 20,600. So under which one of these systems would it look like we made more money, at least in terms of gross margin? Which one did we make a higher gross margin on?
FIFO.
FIFO, you're absolutely right. All right. And then let's talk about the lowest cost or market, because I know we have something on that. So on this one, it has to do with when we're figuring our ending inventory. So lower cost to market, it's that you either have to take either what your cost was or what the market is. And you're going to take the lower of the two. And so that's what this is doing. So we're going to compute either the lower cost of market or the lower cost or the market for the ending inventory applied separately for each item. So we see here that the helmets, our cost is going to be lower. So if you take $50 multiplied by 24, comes out to 1,200. If we look at our bats, we see that our cost is pretty high, and so we're actually going to have to take is higher than market, so we're going to have to take the market price. So market, so 25, or actually we're just figuring out the totals now, excuse me. So if we just multiply 50 by 24, we get this, and then 54 by 24, we get that, and then we just do that for each one, I'm sorry. And then we figure out then, I was jumping ahead, then we figure out, okay, which one are we going to do? So for example, for bats, we're going to have to take the market price value. For shoes, we're going to have to take the market value, and for uniforms, it's actually the same. So then we're going to have to go back in and adjust, and we see that we had a loss of $254, and so that is the 7,648, which is our cost for the merchandise, minus the market value now of the merchandise, which is, or the LCM applied, which is 7,394. And so that would be, the loss would be recognized as the year-end adjusting entry, because we had our merchandise and we realized that it's now, we couldn't sell it for more than what our cost was, because some of it has gone down in value. Okay, so you figure out what the cost, what you originally paid for the merchandise, which is the cost, and then either of the cost or market, what the total of that would be, and then that figures out your loss, and then that's what you would enter in as your adjusting. A cruise company uses LIFO for inventory costing and reports the following financial data. It also recomputed inventory and cost information using FIFO for comparison purposes. And so we'll compute the current ratio, the inventory turnover, and the days sales and inventory for 2017 using LIFO numbers and FIFO numbers. So we see here that, again, so this first one is for the LIFO. So we see here that the current ratio is your current assets divided by the current liabilities. So we see here that under LIFO, although that really wouldn't change, you have, so 220 divided by 200, that's 1.1 to 1. And then you see here then that the current inventory turnover, again, is the LIFO cost of goods sold divided by the average of the LIFO inventory, which they give you here. So 740 and then divided by 135, which is 5.5 times. And so then the days sales in inventory is the LIFO inventory divided by the LIFO cost of goods sold. So to be multiplied by 365. So you have 160 divided by 740 times 365 is 78.9 days. And then if we do the same thing then, but with the FIFO numbers for FIFO, so you get 300 divided by 200 is 1.5 to 1 for the current ratio. Inventory turnover is the FIFO cost of goods sold divided by the average FIFO inventory. And so you have 660 divided by 193. How they get the average inventory for the LIFO or FIFO is, let's say we'll do the one for FIFO since that's the one you're on, is you take 240, which was the FIFO inventory from 17, and then add what it was, which is the 145 for 16. That comes out, divide that by 2, comes out, and you can round since it's a 0.5, you'd round up. So 192.5 becomes 193. Okay, so that's how they figured that out. So 3.4 times. And then the days sales inventory is the FIFO inventory divided by the FIFO cost of goods sold multiplied by 365. So 240 divided by 660 multiplied by 365 is 132.7 days. So overall, users prefer the FIFO numbers for these ratios because they're considered more representative of the current replacement cost of inventory. Because again, with FIFO, you are selling your oldest inventory first and then bringing in more inventory, and then you're counting the costs on the more recent inventory that way. 6-13, which is the inventory turnover and days sales and inventory. So we're going to use this information from Palmer Company to compute inventory turnover for 2017 and 16 and its days sales and inventory at December 31st, 2017 and 2016. Comment on Palmer's efficiency in using its assets to increase sales from 16 to 17. So we will use the above information to compute inventory turnover for 16 and its days sales and inventory for December 31st of 16. So inventory turnover, again, as we said, is the cost of goods sold divided by the average inventory. And so again, to figure out the average inventory, anyway, you take the average inventory, so that comes out to 4.7 days. And then you have the days sales of inventory, which it multiplied, which is the ending inventory divided by the cost of goods sold times 365. So that would be 87. And again, we're just doing this for 16. So we have 87,750, and then divided by the cost of goods sold for that year, which is 426,650 multiplied by 365. So that's 75.1 days. That means the inventory stays in, or they sell through. That's how long it takes to sell through the inventory. And then using information, we'll do the same thing for 17. Oh, you know what? I get it. I get it now. So for 17, you can go ahead and figure out the average for all three, and that's where they get that. So they add up the ending inventory and divide it. They get for 16, it would be because we only go out to 15. So it'd be, we're not worried about 17. It would just be 16 and 15, add them and then divide them. And that's how they get 90. So you have the cost of goods sold then for 17 is 643,825. And then again, you take then all 3 years, add them up, divide them, you get 92,575. And then the days in inventory is the ending inventory divided by the cost of goods sold multiplied. So that's 52. Comment on Palmer's efficiency in using assets to increase sales. So what do you guys think there? Okay, yes. Okay, you're helping me, Jacqueline. Yes, so yes, you would add, so to figure out the average inventory, you would, yes, so for 16, you would go ahead and add the ending inventory in 15 and 16 in order to figure out for that one. And then for this other one, then you would just go ahead and add all of them up. You're right. Thank you. And then real quick, what do you guys think about this? So they increased their sales, and so they were more efficient with their use of their inventory in 17, right? We don't know what exactly they did, but we see that, right? And do you think, let me just ask you, do you think that's significant that they, in 16, they had 75.1 days of inventory at any one time, but that in 2017 they had 55.2 days of inventory is what they ended with. You think that is significant that they were doing that, able to manage, did more sales, and that made a difference?
So less inventory results in more sales.
Okay. It did, yep. All right, so let's look at, okay, so we'll talk about, I think the last one we'll do is 616. We'll do this one, and then so this one is estimating the ending inventory for retail, which, as I said, sometimes normally you wouldn't do this, but sometimes you would. So in 2017, Dakota Company had sales at retail of $260,000. So the above information is available from its records at the end of 2017. So we'll use the retail inventory method to estimate Dakota's 2017 ending inventory at cost, and then we'll round the cost ratio to the nearest whole decimal. So they had a beginning inventory at cost of $63,800, and so that was what it cost them, but the cost at retail is what they're selling it for, which would be $128,400. And then they purchased at cost $115,060, and then at retail for what the amount that they additionally purchased was $196,800 is what they're selling it for. So then the cost available for sale cost them $178,860, and then at retail, the price what they're selling it for is $325,200. So the ratio then would be 55%. Because again, if you take the available for sale at cost, divide that by at retail, that's what's going to get your percentage. All right. And so then the net sales at retail then was 260,000 because they're telling you that. So the ending inventory at retail price was 65,200, and so you can work back 55% of that is 35,860. So if I take this and multiply by 0.55, that's how I get that amount. Okay, so to figure out, because you want to figure out, you know, the retail, what you sold it for, but you don't know the at cost. And so that's how you could figure that out. Okay, it's just to take the retail for the ending inventory, multiply that by the cost to retail ratio. That's going to get you a good idea, a fairly good idea of what it cost you. And then we can figure out from there then what the net sales at retail were for what it cost us.